Hello there, ladies and gentlemen, and a very, very warm welcome. Welcome to you all from indeed all around the world. We're seeing lots of people here join us from so many places. We're delighted to have you here. I'm Ethna Trainer, and I'm your moderator for this session. The title of this webinar, LNG, Short-Term Pain, Long-Term Gain. So let's see how that plays out today. This has been organized by the Al-Attiyah Foundation and Refinitiv. So we're delighted that both groups have come together. The Al-Attiyah Foundation, of course, is an independent think tank aimed at providing robust and practical knowledge and insights on global energy to you all. Sustainable development topics also right up there at the top of the agenda. And really what we want to do is share this knowledge for the benefit of all the foundation members and community. Now, let's just take a quick reminder of where we are in the LNG market. And when we look at the LNG sector, there was already oversupply and low demand before the impact of COVID-19. And looking at prices, they're below $2 in Europe, US, and Asia. So we're really still looking at that sustained fall in LNG demand, but COVID-19 has really accelerated that. So it's certainly time, I think, for the LNG community to revise strategies and the CapEx plans for 2020. We're hearing all about that. It's still making the headlines. There's really no choice. It has to be done. But again, we have to look at what this means for investment as well. Also looking at construction delays and possible projects and FID as well. But despite these tough times, I mean, we really look at the gas demand that was lost in 2020, and for the most part, everybody expecting it to come back on board in 2021. Now, in this webinar, we're going to hear from three industry experts. We're delighted they're with us, and they will really look at the biggest challenges facing the LNG industry today and, of course, the opportunities therein. Very, very quickly, let me bring you through a few quick housekeeping items that just to make you aware of. Any technical issues, please just let us know. Somebody will be on hand. Plenty of people in the back room there just keeping an eye on things, and they'll make sure that you're focused and you've got everything. You can see the horizontal buttons there next to the red X, so that will activate the Q&A and the poll window on your screen. We really want you to be involved in this, so make sure you do respond to us, make sure you get your questions ready for our three presenters, and of course we'll do our best to make sure that we get them to it. And the poll question too, we've just got two of them. We'd love your input into that as well. Now, it will be recorded, so all of you are here, you're with us for the duration. And of course, we will have that recording to send out to you. So that's even more exciting. We'll make sure anybody who's registered has it. Let me get down to business. Enough of this. You need to know who we've got on our panel. And we're going to start off with Luke Cotell. And of course, he's an LNG analyst with S&P Global Platts Analytics. Luke will do a presentation, and then we will engage in a conversation with both of our colleagues. We'll be joined then with Wayne Bryan, with European Gas Research for Refinitiv. Of course, a great, strong background in the industry, in consultancy, procurement, really looking at the commodity industry. So I'm really interested to see what Wayne's got to say on this. And equally, Graham Wildgoose, he is the manager at Potent LNG, looking at the natural gas and the consulting group, really looking at Europe, Africa, and the Middle East. Again, a long time player in this industry, to looking at LNG supply chain, investors, lenders, governments, the whole lot. So there's a lot going on here, a lot to digest. So let's get down to business here. Luke, I'm delighted that you're going to do a presentation. I've had a quick glimpse on it, so I'm sure all of our viewers are really, really interested to see what you have to say. Bring us up to speed, what's happening in the market, and then we'll have Wayne and Graham on standby, and we'll all be ready to get involved in this conversation. Luke, I'm going to hand it over to you.
Brilliant. Thank you very much, Etna. And thank you as well to the organisers of today's event, the invitation to speak. Looking forward to the next hour or so. Surely it's going to be a very interesting discussion. So as Etna says, I'm going to kick things off today with a quick 5-minute presentation or so, where I just want to set the scene around the topic of today's webinar, which of course is LNG, short-term pain, long-term gain. So let's start by focusing on the first part of that title, LNG short-term gain. Now, I'm sure you're all aware that the LNG industry is by no means alone in feeling a significant price suffering in the wake of the coronavirus pandemic. However, what is particularly notable about the global gas market, and with that the global LNG industry, is that even before the coronavirus pandemic hit at the beginning of this year, prices have been falling on a negative spiral for somewhat of 18-month period. And we can see that on this graph here. If we look at the JKM price, the landed price of LNG into Asia, We see in late 2018, it was priced around $10 per MMBTU. Fast forward to late April 2020, and the price has plunged to a record low of $1.83 MMBTU. So how did we get here? Well, we had 2 consecutive warmer than normal winters in a row. And on top of this, we had extremely strong supply growth out of Russia, Australia, and US, when new LNG export projects were hitting the market at the same time as we had warm weather and weak demand growth in the Asia-Pacific region. All of this meant the market was forced to lean on the European market to balance, pushing gas into storages and incentivizing additional demand through lower prices and subsequent coal to gas switching. Then, of course, at the start of this year, in Q1, we had the global coronavirus outbreak. And what this has really served to do is just exaggerate an already very oversupplied market with weak fundamentals. And as a result, we've seen JKM, TTF, and Henry Hub all head to record low prices, and we've seen the 3 major gas hubs converge on each other. And for a short period last month, we even saw Henry Hub, typically the discount global gas benchmark, prices to premium in the global gas industry. So I wanted to put up a couple of charts which maybe best summarize the state of the market today. And it isn't easy to pick 2 charts because I'm sure we'll discuss there's lots of interesting stuff right now. But these are the 2 charts I did come up with, and let me walk you through both of them. So on the left-hand side, I'm showing European storage stocks. Now, why are European storage stocks important? Well, as I say, Europe is the global gas balancer. And what we mean by that is that during times of oversupply, the global energy market will push surplus cargoes into Europe, where abundant regasification capacity and plentiful storage capacity means that simply surpluses can typically be absorbed. And this is what we saw last year. If we look at the blue line on the left-hand side chart, that's the storage levels in Europe in 2019. And we can see they were well above 2015 to 2018 levels as the global LNG market was leaning on Europe to balance. But the big problem is that if we look at the winter of 2019, so late 2019 and into 2020, what didn't happen was the market did not normalize these elevated storage stocks. And as a result, as we exited winter this year in Europe, storage levels were significantly elevated. And on top of that, the additional blow, the coronavirus on European downstream demand and the room for injections into European underground storages this summer was substantially reduced. And what this means is that the market can no longer rely on Europe to simply balance. Instead, what we are seeing is that the market is facing the harsher reality of marginal cost economics. What do I mean by this? I simply mean the market is being forced to price at a level which gets the marginal source of supply to turn down. And this is what we're showing in the right-hand side chart. Look at the unprecedented fall in global liquefaction utilization over the last 2 months. We're well outside of the 5-year range, and that is a direct sign that global supply is responding to these record low prices. And specifically, it's suppliers like the US, Malaysia, and Egypt who we see forming a large part of this supply response. Now, we're going to talk a lot more about the short-term outlook, but before we do so, I also want to quickly touch upon the second part of today's title, which is LNG long-term gain. Now, where might the gain come in the LNG industry from the coronavirus pandemic? Well, one of the things we've seen is there has been a substantial slowdown in new projects reaching final investment decisions in 2020. As international oil companies and national oil companies delay spending plans, cut capex expenditure as they reassess the future of the energy markets and their businesses. This is going to filter through into the 24 to 26 period, in that we will have less supply growth in this period had we not had the coronavirus pandemic. That said, we need to bear in mind that 2019, before the coronavirus pandemic hit, we saw a record amount of final investment decisions on global liquefaction capacity. 87 BCM worth of projects reached final investment decision in 2019 alone. And these are locked in. Even after the coronavirus pandemic, they're still going to be hitting the market in the 24-25 period. And thus we need to think, where is this growing supply going to find a home? And this is where I move to my final slide. And this is thinking about the long-term demand picture. And what I think is really notable in this chart is that the mature markets of Japan, Taiwan, South Korea, in Northeast Asia, and of Europe are no longer the growth markets for the global LNG industry. Instead, the market needs to continue looking at China, which for the last few years has been one of the strong catalysts of demand growth. But also we need to look at the emerging Asian economies where we're seeing growing power demand, declining domestic production, all present a big opportunity for LNG demand for LNG in the energy mix. However, I want to caveat with this point that this demand is by no means certain. It's not underpinned by long-term contracts. The infrastructure is not already built. And instead, what we need to see is we need to see the right mixture of policy support, infrastructure build-out, and competitive pricing against competing fuels for LNG to be able to find its way into these large potential markets across emerging Asia. And with that, I'm going to hand back to Etna, and we can hopefully get into today's discussion.
You know, they're very, very clear in the fact that we know where they're going and we know where they came from, but the speed at what has been happening, I think, is what really maybe, you know, caught the market just off guard a little bit. It caught the world off guard a little bit. We're going to talk with all of you in terms of the impact of COVID, but I'd like to get our audience at home involved quickly, if I could, in a poll question. So if we could have our poll question up there, and we'll share that with you here. And you briefly mentioned there, Luke, when we looked at the price of JKM, but now, of course, let's look a little bit beyond that and just see where our audience anticipates that's going to go. And we don't have a speed range on this one, but you gave some bit of a time outlook there. So let's have a look there. So see, where do you think? Less than $4 or $4 to $6? Can it go 6 to 8, or can it actually go above 8? So we're just giving you prices at the moment. We're not asking you to do the math and figure out when that might happen. So we're letting you away with that one. But it'll be interesting just to see what's going on. Look, we'll come back to this in a minute because I'll wait and we get a bit of a gauge and see what's happening there with people. But also just if you can, talking about what you were talking there in terms of, you know, the situation for Europe there and the storage that had been elevated. Will the market ever be able to actually rely on Europe again, or is this sort of short term in terms of being able to balance that and be able to come back? Or in fact, we have our results of the poll. Maybe we'll come and take a look at that one first. All of you are looking at that, and we'll come back to Europe in a minute. There we go. People have expectations, great expectations, for the $4 to $6. What do you think on that one, Luke?
Yeah, it's a really interesting question. I think if we look at where JKM prices have gone in 2019, we were up at the highs of a $10 average. In 2020, in the year to date, we've seen prices collapse, and the price over the year to date has averaged just $3.50. And I think I would broadly say Platts Analytics is in line with what the poll has come back at, in that we see the price averaging in the $4 to $6 range in 2021. What we do see is that we think prices in the current cycle have bottomed. We do think the summer of 2020 represents the weak point of the global gas complex. And moving to 2021, what we expect to see is hopefully we see the coronavirus and the impact of the coronavirus in the rear mirror. And what we will then see is the slowdown in new liquefaction projects coming online. Next year, the US build-out has very much come to an end in terms of the first generation. We will see a slowdown in new supply hitting the market. And what that should mean is that Asia-Pacific demand growth can outpace global supply growth and draw down on the push of LNG into European storages, and to some extent help us normalize. But of course, I also see that quite a few of the attendees have gone less than $4 poll option, and this of course makes sense. There's a lot of risks in between now and next summer. Maybe how does the coronavirus pandemic play out? Will we get a second wave with a subsequent impact on demand? And there is definitely more downside risk to our forecast of that 4 to 6 range than upside risk.
Now, Graham, I'd like you to have a look at this too, and look at the poll results there. You know, the big focus, of course, is looking 4 to 6, but then quite a few people as well looking below 4. But also perhaps bring me up to date too in terms of where you think the biggest fallout has been on the gas market for COVID-19?
I mean, firstly, I think given the unprecedented kind of uncertainties of where we are at the current time, I don't think anyone really has the first clue of where oil and gas prices will be in 2021. I think next week will be a challenge, never mind a year or 18 months' time. I think, as Luke mentioned, much is going to depend, obviously, on the speed of economic recovery. Will there be second waves, second lockdowns? Nobody has a good answer to this at present. If you look at JKM, the futures curve, I think for 2021, when I looked yesterday, was averaging something around $4.6 per MMBTU. So it doesn't surprise me that the majority is in the $4 to $6 range. I think our latest forecast is something like 4.1. So we're at the bottom end of this range and probably slightly more pessimistic than the futures curve. However, I think it wouldn't be difficult to imagine a significantly more optimistic scenario than this if there's, more of a bounce back in oil prices, and there's a step change in economic activity, or perhaps a vaccine emerges for COVID-19, and we can get back to our normal lives more quicker than perhaps we anticipate at the moment.
Indeed, yeah, and I think it's what everybody is really looking for. The world is very much on hold. Wayne, let me bring you in here. And of course, I mean, that phrase, I think that's been overused around the world, unprecedented times, without a doubt. I mean, nobody could have seen this coming. I think we were in, there was a lot of issues around the economy. There was a lot of issues on demand already in place. And then when this happened, keeping an eye on that poll question there for a quick comment. And also, if we may, your take on the whole fallout of COVID-19 for the gas market.
Yeah, well, I completely agree with the guys and what they're saying. I mean, they covered most of the points that we are looking at as well. I think, like Graham said, no one's really got a clue from tomorrow through to next week, let alone into 2021. But I think the speed and the pace of the economic recovery is going to play a significant factor in this.
Yeah, I mean, this has got to be what it is. And I think, it's interesting when we look around the world, what's going on. I just saw a report coming out of India where the Indian minister, the energy minister, actually talked about the fuel demand that's coming back. That was some good news. We're seeing a little bit in China, but then we look at what's going on in the US, and we look even in the UK where we're seeing lockdown in selected cities. But the fact that this is happening, I think this is the big fear. So getting through the week is probably number one priority. Luke, let me bring you back in here. So talk about, we'll have a short-term vision coming out of this discussion, I think, today, and people should be happy enough with that for now. Luke, come back and talk to us when we look at the situation in terms of oversupply on the market. I mean, obviously, naturally, this was going to happen, and, storage reaching tank tops, even just particularly in the last 2 quarters here. The supply obviously has been swiftly curtailed at the moment, but what's the situation both in the oil and gas side here? But what can we do? How long can how long can we sort of wait in terms of that demand coming back for the available gas that's there?
Yeah, it's a great question. I think we've seen, if we look at Asia Pacific LNG imports right now, we have seen them start to trend back to some sort of normal. If we look at Asia Pacific LNG imports on a 30-day moving average, they are now back to year on year. So it does look as though the worst of the coronavirus pandemic demand impact, especially on the gas industry, is probably past us. And that's true in both Asia, and it's also true in Europe, where we're seeing low prices help generate extra coal to gas switching, and thus demand is actually quite comfortably now sitting at the higher end of the 5-year range. But the big question probably is looking further forward. When do we not just see flat demand in Asia, but when do we see strong growth, which can actually move us away from this period of reliance on Europe and move us into a period of a tightening market? And certainly there remains a lot of uncertainty around that, as the guys have alluded to. Will there be fresh outbreaks? Certainly some of the Asian economies, some of the major markets have had more success in tackling the coronavirus outbreak. If we think about the likes of Japan and South Korea, some of the major markets there, but we have still seen a demand impact on the power sector as the wider global economic backlash also affects these countries. So it's very much a mixed picture with demand, where we are seeing a recovery, but it looks as though it will be quite a slow and drawn out process until we get back to strong year-on-year growth across Asia.
Indeed, I think all economists, producers, just about consumers, everybody really watching that very carefully. Wayne, come back in and talk to me about when we look at the market getting used to the LNG shut-ins, particularly from the United States. But how has this been playing out for the European market particularly? Wayne, this one to you. Are you with us? We have occasionally a little bit of technical problems on this. I think you've got muted on this. This is the one downside about doing this. It's great that we can get everybody together, but occasionally we lose you. Give it a try there. No, and I think you're muted again. Maybe I'll leave you play around with that. Graham, do you want to have a look at that question, or I'll just maybe move a different one onto you? And particularly when we were in touch earlier, you actually said that LNG gas markets, in fact,
they're working. Yes, I think. Now you're now muted as well. We're all having some fun here. I guess it leads on from one of Luke's points that really, low prices. There's a lot of obviously concern around at the moment, but they're not really a sign that the market isn't working. And in fact, it is working. As Luke mentioned, what we're seeing is a significant supply response on the LNG side, primarily out of the US, as a result of the very low global prices, and basically suppliers in many cases unable to even cover their cash costs of production, and therefore as a result of this, they're choosing to cancel the cargoes. And I think the latest numbers I've seen, there was around 100 cargoes estimated to have been cancelled through the end of August, which is something of the order of 7 million tons of LNG or thereabouts. So it could be about around 2% of annual global supply. So it's a significant amount of LNG. But if you look at the forward curves of Henry Hub and European prices and JKM, this sort of respite on the supply side, if you like, is likely to be fairly short-lived. I think from about November this year, it looks like cash margins look to be broadly positive, and if that is the case, we would expect these shut-ins, particularly with around the 2-month notice period that you need to give for these cancellations, to largely stop by Q3, Q4 this year.
Wayne, come back on this one now. Hopefully we're all working here and we can all hear each other. It's good. I think the market getting very used to what's happening with the LNG shut-ins from the US, and even as Graham was saying there, that 100 cargoes, that's a lot. That's an awful lot of gas off the market. But how is this playing out and impacting the European gas market?
I think, as I was saying, I think we saw the prices were bottoming out when we got sort of towards the end of May with the large oversupply that we were seeing. Then we started hearing rumours of US cancellations, US shut-ins, and of course we've seen over the last June, July, and now August, I think a total of over 100, 125 cargoes have been cancelled. Since then, the price reaction has been pretty remarkable in terms of TTF and MBP. So TTF was probably since the end of May to today, it's increased by about 70% or to 2.7, 2.8 euros. And if you look at the UK front month now, that's more or less doubled. We were at about 8 pence a therm, and now we're at close to 16 pence a therm. So as much as we saw a response in terms of expectations of supply, we've also seen some producers turn down as well. But I think the LNG is the big surprise. At the start of this summer, we did our summer outlook just before COVID even started, and we were already looking at an acutely oversupplied European gas market for this summer, mainly driven by about 4 BCM additional LNG. Now that's been taken away. What we've seen from there moving forward is prices adjust back towards that level now as supply has tightened. And I think the acute oversupply we expected is no longer the case. I do see a recovery, and if you look at the contango in the forward curve, you'll see TTF trading above Henry Hub, probably in the winter from October onwards. So I think that will drive US LNG shipments back towards Europe and Asia.
And of course, we'll be keeping an eye on the weather forecast as well for what we're going to.
And of course, COVID. We mentioned it, but the demand concerns around that are still quite strong, and we still don't know moving forward where we're going to be in the winter.
And I think it's that uncertainty that really makes everybody very nervous, not just alone in this market, but when we look at the financial markets, we look at just the state of the global economy. I think that's the one thing, and the unfortunate fallout on that is everybody just stops and does nothing, which is not good either. Now, I'm very happy to be home to please put your questions in. We have plenty of questions, but I'll make sure we get to yours as well. And I have one for Luke here from Nicola Joseph, who says, Luke said that the infrastructure and policies need to be in place for new LNG markets. Which countries does he see are already taking the lead in this?
Yeah, it's a brilliant question. I think one of the examples we can look at it is China, where we're really seeing some liberalization of the market, which should help generate some stronger demand for LNG imports. And what do I mean by liberalization of the market in China? What we have seen is we've seen the pipeline network unbundled into a separate company called Pipe China. We're also seeing increasing third-party access to regasification terminals in China. They're moving away from typically the three barrels, CNOOC, Sinopec, and PetroChina, who were the dominant players in this industry. And now we're seeing new emerging entrants in the Chinese LNG market who can access regasification capacity due to new third-party rules. So the combination of easier access to pipelines due to the unbundling of Pipe China and also third-party access to pipelines at regasification terminals is a great example of where incumbent LNG players can start to access cheap spot prices and realize them in downstream markets. We've also recently seen in India, they've just launched a new gas hub. Now, the immediate impact of this is probably quite likely to be limited, but certainly it is a sign of a bright future for Indian pricing and, in particular, price discovery in India. We all know the importance of fundamentals reflecting in downstream prices, and launching a gas hub goes a long way, is a start in realizing spot prices in the Indian domestic market, which again is a key potential growth market. So certainly we are seeing developments across the Asia-Pacific region in some of these major economies, and it's a start, but there's certainly also more work to do.
And also, I mean, talking about Pipe China too, we only last week had that huge gas infrastructure deal here with ADNOC. Again, really taking the piping mechanism, the pipeline mechanism kind of away as a separate company as well, which was very interesting. And huge interest in that. I mean, billions of dollars, huge interest. So I suppose when we look at investment, things like that are still happening in the market, and, you know, hugely optimism, it's still there in many areas. So we have to look at some of those deals, I think, to just see that it's not all doom and gloom. And I think what you talk about India as well too, you know, huge market there. And again, they've got to shift their use of fuels. So gas, you would imagine, is the perfect one. Let me come to Graham. And again, almost staying within our focus on a bit of investment here when we're looking at the big projects that are in there. Luke mentioned earlier that many projects had taken FID in 2019, and that so they will be coming on board. But how many greenfield or bigger projects that are under construction will be completed? Maybe you can highlight a few of those for us, Graham.
Sure. I mean, I think as Luke sort of alluded to earlier, the reality is that any liquefaction project that is currently under constructed will be completed. That is a certainty. However, we are already seeing some delays as a result of the current situation. For example, Total has suspended all construction activity at its Mozambique LNG project site. Also, BP has declared force majeure at the Tortue floating LNG project in Mauritania and Senegal, and it's seeking to delay its delivery of the vessel from Golar by about a year. So in terms of projects that are under construction, again, we don't want to harp on the same point. It's difficult to predict how this situation is going to pan out, but it's unlikely that we're going to see delays of more than, say, a year in these under construction projects, regardless of the market conditions, because most of that capital is already committed. However, on the projects that have not yet taken a positive final investment decision, clearly it's a very different story. And more or less all of these projects are currently delayed or stalled at present. And that's quite a significantly long list of projects, the highlights of which are probably the expansions in Qatar, which have been delayed, and Rovuma LNG, the ExxonMobil-led project in Mozambique, which was basically poised to take FID earlier this year when COVID-19 hit. And they've now pushed that back, and they're targeting FID in 2021. So I think we can expect to continue to see pretty much a hiatus until economic activity and the market situation improves on the pre-FID project side. But other than moderate delays, no major impact on projects that are already under construction.
And indeed, I suppose we have to just look at the basic economics here. It's going to take a while for that demand to really come back in place right around the world. And also, of course, the projects that would be taking FID now, these are long-term projects, so it's not as if they were going to come,
I think that's
next year.
I think that's a very important point that's sometimes kind of lost in people's thought processes. If you want to take a longer-term view of the market, then perhaps this is a good time for investing in these projects, because we're certainly bullish on long-term global demand growth after this situation is mitigated. And as we saw in a similar situation probably 10 years ago after the global financial crisis, if we have an extended period where there's no investment and final investment decisions on future projects, it's quite easy to foresee a situation by the middle or early second half of this decade where we get into a market tight situation if new investment isn't taking place. And most of these projects are not looking to be producing until 2025 or 2026. So there is a clear sort of pathway for these projects to move ahead. But I think the current situation with perhaps financing being tight, no traveling for people, makes it difficult to push these projects ahead. But if we can return to some sort of normality in the new year, then we'd expect things to start moving for a lot of these projects again.
Yes, and again, I think in the short term this year, but again, we've all had to put up with bad news, be it on a personal level, a professional level, a corporate level. So I mean, there's levels of bad news, but we just have to. I think the industry just has to deal with it and get over it. But they don't want to see a situation where there's going to be tightness in the market. So I think everybody will have the basic sort of common sense to look forward to see what's going on. Let me bring you in here, Wayne, and let's talk a little bit. And Graham mentioned there about Qatar as well, what's going on there, and looking at who's getting their gas from where in terms of where is it traveling for, particularly what's going on in UK and Northwest Europe. Talk to me a little bit about that and the production that's going on in Qatar as well.
Yeah, fine. I think first of all, just to go back to what Graham said, I think, completely agree with that as well. And looking at Qatar themselves, they've already announced a couple of months ago that they're going to expand their fleet by over 100 ships. And I think they've secured around 67% of global LNG shipbuilding capacity out until 2027, which gives a large indication of what they're doing and where they think the market's going to go. And also the development of the North Field is going to help. And in terms of the UK, we see a lot of gas from Qatar, especially into South Hook, where they have an interest, obviously. And of late, we've seen non-profitable or uncommitted cargoes that they couldn't send to other destinations come into South Hook. So we've seen that has been quite elevated over recent weeks. I think the majority of cargoes into South Hook have been of Qatari origin. But the slowdown is expected in Northwest Europe still to continue over the coming 6 to 8 weeks, even longer. And I think that's the concern on the European gas front.
Thank you for that, and we'll come back in a minute. We're getting a few more questions in here, so please do keep them coming in. Luke, one for you here, I think. With ATC looking to increase LNG trading activity and Bahrain showing interest in LNG tankers as well, are we starting to see shifting interests from oil to gas? Now, this is a very interesting one because it wasn't that long ago we had the CEO of Total on a panel who really just spoke about the concept that we really all need to be looking at the energy markets when somebody threw an almost a similar question to him in terms of his interest in gas as well as oil and that. And we see it for many of the big IOCs. But what do you think? Are we seeing the shifting interest from oil to gas? And one thing I'd like to engage all of you on to are the reasons for this and looking at, you know, where the demand is coming from, environmental reasons, investment reasons around environmental. I think we should have all a little chat on that. So I'll be interested to see what you've all got to say on it. But I'll just turn to you.
Yeah, thanks, Etna. I think, as you said, it's a really interesting question. And broadly speaking, I think what we do see with a lot of international oil companies over the last 5 years or so, as you say, Shell and Total, a great example of companies who have been highly rich on the LNG and gas components of their portfolio. As if we look at the long-term forecast from the likes of the International Energy Agency, we do see that peak gas is seen being further away than peak coal and peak oil. And certainly there are reasons behind this. Many people talk about gas's role in the energy transition and how it can be a complement for renewables in the power sector. Obviously, renewables have a very volatile generation profile. They need some base load which can support, and gas, we've seen it in Europe, can very much act as a complement to renewable energy and push out more polluting coal in the power mix. And there are other reasons. There's big growth markets across the Asia-Pacific region, as we've already mentioned, which have high potential demand for gas growth. But as I say, a lot of this potential growth needs to be competing against alternative fuels such as coal. So I think broadly speaking, we do see a bright future for the gas industry, and that's reflected in many of these international oil companies shifting their portfolios. That said, I do think a lot of companies are now taking a pause and reassessing post-coronavirus. There will be a reassessment. We're seeing an increasingly green agenda put into many economies' recovery plans, and we'll have to see what role gas plays in that. But certainly, if we look at India, it's a great example where gas is locked in, or the government sees gas playing an increasingly role in the energy mix. By 2030, they want gas to be 15% of the energy mix, up from 6% in 2020. That sort of growth story is why we see an interest in gas long term from a lot of these IOCs.
Yeah, and I mean, I really do think we have to look at, you know, the wider picture in terms of the people in the world that don't have access to energy. And I would imagine that, you know, gas, what I'm hearing too, is the fuel of choice for that. Graham, come in on this. Talk to me about where does gas sit? I mean, we used to look at it. A lot of people talked about it as the transition fuel. A lot of people talked about it as the destination fuel. Where does gas sit for the longer term, do you think, right now?
Well, I think it's easy to have, you know, for us sitting here in Europe, it's easy for people to have too Eurocentric a view.
Yes.
And obviously, you know, there's been some really strong moves to decarbonize the economy here in the EU and the UK, you know, net zero targets, et cetera, which obviously, you know, gas will play a role in the interim. But if you're talking about net zero carbon emissions, then, you know, that's not a positive environment for any hydrocarbon fuel. There's no getting away from that. However, you know, I think the rest of the world's a different story. And as you mentioned, Etna, you know, there's a huge number of people in the world that, you know, there's a desire of governments to bring out of poverty, supply electricity to, et cetera. And I think for many developing countries, those considerations are going to continue to trump climate considerations, whether some people like it or not. Now, I certainly believe that you know, although you can't be generic, it's very much a country by country analysis, that gas and LNG have a strong role to play over, you know, the sort of 20-year time frame that we can reasonably look at to play a strong role in meeting that growing demand alongside renewables in many cases.
Wayne, talk to me about, you know, when you look in your day-to-day work and looking back and, you know, your experience in this industry and that. I mean, is environment up there on the top of the agenda for traders at the minute? I mean, you know, it's something that people are really caring about. Yes, The investors are really looking, at ESG. They're looking very carefully at this. Everybody really has to be looking at it. But when we look out, to the future as well, and we look at who should be using gas and why should they be using gas, and therefore the healthy demand that should be there for gas. How high do you think the concept of sort of the green, clean future in the environment sits in terms of the decision makers?
Good question. I think prior to COVID, you would say the green agenda was a lot higher. I think as we move into COVID, now moving out of it, I think the green agenda will play a lesser part. And like Graham said, I mean, you've got this emerging demand in places like India, Pakistan, Bangladesh. I hosted a webinar a couple of years ago talking about the development of these countries, and it's interesting to see how far they've come since I did that, which was about 2 to 3 years ago. So I think gas is going to continue to play an important role over the next 20 to 30 years. Renewables are growing, of course, but again, they're intermittent. And with the big coal to gas switching going on in likes of Germany now, gas still has a very important part to play. And I think because of the COVID-19 pandemic, I think it's going to give gas a little bit more longevity than previously thought. So I still believe, like the guys have said, that gas still has an important role to play, especially when you consider the alternatives and the fact that renewables growing very strongly, still intermittent. So if the wind doesn't blow and the sun doesn't shine, what do we turn to?
I think points like that have been really very visible, I think, particularly during this COVID pandemic when, we've needed the consistency, the power in our hospitals and everywhere else. I mean, it's, if anything, the case for, sustainable and non-stop sort of uninterrupted power couldn't have been clearer. So in many sense, I think people are beginning to realize that. But
and the cost too. So I didn't mention the cost. I mean, you look at the cost of it now; it's very cheap.
Absolutely. Yeah, it is. It's a time, I guess, when we're looking at that shift from, especially out of coal, I think it's making huge economic sense. Luke, talk to me a bit about the wider LNG market and, the key players in this, the investment for them. I mean, we've got big players in this market. And are these the ones that are going to maintain their key positions for the years to come?
Yeah, great question. I think when we look at the global leaders today, we look at the top 3 producers, it's Qatar and Australia at the top in terms of exports, and then the US has very quickly climbed the ladder into 3rd place. But if we look at the coming decade, and we think about where is the big growth for LNG exports, I really think we need to pin it down to 3 key markets. The first of those is Qatar, who has obviously been a leader in the industry for well over a decade now. The big North Field expansion is only going to grow Qatari export capacity and cement its place as a major player in the LNG industry. But outside of that, we see the other 2 big growth markets to be Russia. Now, in Russia, we see LNG has for a while been a key political and strategic aim of the government. And it's taken a while really to get some momentum behind the LNG project growth. But now Novatek has really emerged as the leader for Russia in the global LNG space. I think what's particularly interesting when we think about Russia as well is that LNG for Russia is not just a way of boosting exports, but specifically they want to use LNG as a way of boosting exports to Asia, of increasing links to a market where they do not currently have most of their pipeline exports go to. If we look so far, most of the exports out of Yamal in the Arctic Peninsula have gone into Europe. But longer term, we see expansions in Yamal. Novatek have said around 80% of that gas is going to try and land in Asia. And they are bringing on new nuclear icebreakers to open that Northern Sea route year round. They're also building transshipment facilities in the Far East. And all of this is aimed at increasing the competitiveness of Russian LNG into Asia. And it makes a lot of sense, right? Russia does not want that LNG from Novatek's Arctic projects just to be competing with Gazprom for pipeline market share in Europe. And the 3rd final pillar is the US, where, of course, we continue to see strong capacity growth. The 1st generation projects are now online. And we have seen the likes of Golden Pass, LNG Canada, the Sabine expansion all reach FID last year. And we can continue to expect these projects, which have fundamentally changed the market in providing a lot more flexibility and growing portfolios. These will continue to do so. These are going to continue to catalyze a more efficient global LNG market as we get growth out of the US in LNG supply. So these are really the three key markets where I think the industry needs to be looking to as the future leaders in the LNG space.
Luke, just staying with America for just a few minutes. I mean, we're hearing about a few bankruptcies and Chapter 11s that's happening, particularly in the shale plays at the moment. Anything, that we need to be watching out, particularly for the gas players, or are we looking more at these guys in the oil market?
Yeah, I think it's a fascinating question. The US gas market right now is certainly very interesting. And if we look at pricing in the US, Henry Hub right now is down at $1.50 as well, pretty much a 20-year low. I think the month ahead contract reached last week. And that's a recognition that the gas industry in the US is also under significant pressure. It's not just the oil industry. But going forward, what we can expect to see for gas players in the US is that as associated production declines from these oil fields, if we look at new rigs drilled in the likes of the Permian Basin and other associated basins in the US, they've dropped substantially since the oil price collapse. And that's actually setting up for a more bullish outlook on Henry Hub over the next 12, 24 months, because associated gas production is going to decline, and thus Henry Hub is going to have to price at a level which says to these players who operate in the dry gas fields, you need to start turning your supply back on. So the operators in Haynesville and Marcellus Utica, they are going to look to see higher prices to bring production back up to meet a large demand pool in the US. So certainly there is a bullish emerging story in the US because of these associated gas production declines on the back of the oil price rise.
Now, Wayne, if I can bring you in here, I kind of got a double question here from you, kind of part one I have, and I'm going to mix it in with another one here. You talked about the harmonization of global gas hubs, and particularly in the European market, but also I've got a question here from Mazen Al-Salah, and asking, where is the real danger to LNG imports in the short and medium term? Is it because of the low-priced coal, renewables, or cheap gas? So maybe they're two separate questions, but I'll leave them both your way, because I am conscious we've only just got a little bit, about 10 minutes left.
I think in the short term, I think definitely European markets specifically, we have a very good supply in terms of Norway, the likes of Russia. So that could be a slight change, but I still don't see there being a big risk at the moment. I mean, we've seen the prices has been one of the main reasons why we've seen the fall in LNG, but I don't believe at this present moment in time there's a big risk for that. Demand will recover. You can look at the forward curve, and that gives evidence of that. H2, I think, this year will be a bit different in terms of H1. So I don't think there's a big danger of any threat in the short term. And medium term, as we've already discussed, I can only see from next year more growth coming onto the market. And of course, gas is still going to be needed. When you look at Europe at the moment, we have very low nuclear availability, which is also weighing, which again is exacerbating the need for gas.
And tell me, how about that harmonization of the global gas hubs? Is it happening? Will it ever happen? Can it happen?
Well, you saw the chart that I sent in that we put up earlier. Yeah. That shows of the changes we've made over the past few years, and I think the US has had a significant part to play in that. If you look at probably from sort of Q4 18 onwards, we've seen the LNG market has been in a state of oversupply, and Europe has been acting as the sponge, so to speak, to balance that market. And then what we've seen this summer is, as Europe's been oversupplied, the price signals then dissuaded any further imports.
Graham, one for you here from Mustafa Khalil. Mustafa asking, when will the LNG markets balance? It's the million-dollar question, isn't it? When will we see some more FIDs for LNG export facilities been taken? And Mustafa, we did kind of touch on this a little bit, but I'm going to hand this one over to Graham.
Yeah, I mean, we see scope for new supply coming into the market, maybe around 2025, 2026. So if you take a sort of generic 4-year construction time frame, then 2021, 2022, I think there's scope for some new FIDs coming in to feed that growing supply gap. And as I mentioned earlier, if that doesn't happen, there's a risk we move into a more tight market situation later in the decade. So again, when LNG markets balance in the short term, and it's the same answer to the previous question about the risk to LNG imports in the short term, it's really when does economic activity pick up again? And the risk is if we have a continuation of these sort of dire circumstances for an extended period, then for sure gas and LNG markets.
And absolutely, I think the key area we've really got to be looking at. Question from Sarah Al-Sala. I'm going to give it to you, Luke, but I want Wayne to come in on this one afterwards if he can. How can LNG in floating storage right now ever be economical at these current prices?
Yeah, it's a good question. I think Wayne referred to earlier, when we look at current prices on the TTF and the JKM curve, floating storage is all about the contango. So it's not about the absolute price level. What we're talking about when we look at floating storage is what is the benefit from staying on the water, and rather than delivering into the current contract, delivering into the month ahead contract. And if we look at Europe, because the market is so weak right now and storages are so elevated, what we see is there's a significant contango between summer-winter prices, because we will go from very full storage into withdrawal season. And once we do get into withdrawal season and we can start to draw down on those record storage stocks, then prices are going to improve. And thus, in the current market environment, the contango is supporting a floating storage play, as is a very low charter rate as well. What we've seen is that as supplies come off, we've seen a surplus of ships on the water, and as a result, shipping rates are very low, and thus the actual cost of float is not that much. So there's a lot of factors supporting a floating storage play into Q4 this year.
Wayne, come in on that, and I take your point. You did clearly point that contango out to us in your very dramatic looking chart there, indeed. Yes.
Yeah, no, exactly what Luke said. I mean, if you're looking at the moment, it's encouraging floating storage, and that's why we're seeing floating storage at record rates. Allied with the cheap freighter rates, then yeah, that storage is still going to be there. I think when we get towards sort of at the end of Q3, if we see demand start to pick up, we will see this floating storage utilised, especially you might see a lot more into Northwest Europe. I still think there's a good downside risk towards sort of the end of Q3 that we may see additional LNG cargoes into Northwest Europe that we didn't expect. And I think if demand in Asia doesn't recover quick enough, we will see that floating storage. You'll see again, we may turn into the balancing market for a month or so as people look to offload that ahead of the winter season. And the winter season is still a bit early. We don't know where the weather's going to be. We don't know where economic activity is going to be. We don't know where nuclear availability is going to be in Europe. So there's a lot of concerns going into this winter as well. I mean, it could go either way, but it's still too early to really ascertain where we're going to be at the end of next month, let alone at the end of September.
Yeah,
it sounds like a recurring theme and excuse, but it's not. It's just very hard in this environment, especially we all work in research, etc., to try and accurately predict and forecast. Because if you look at the stock market, it's been akin to a roller coaster since March, yet the last quarter has proven to be the best quarter, I think, in America since the late 90s. And the DAX went up 24%. So they're pointing towards some form of recovery, which I still think is a little bit overcooked in terms of if you look at the wider environment and you read what people are saying. So it's just too much uncertainty.
It is. It's really, yeah, we're all on standby, I think. And
I'm glad I'm not a trader anymore.
yes. You'd be very nervous. You probably wouldn't be here with me. You'd have said no. Point. But again, I mean, I do think it's like, we've never been in a period of so many sort of unknowns. I mean, we're really here. I'm taking one last question. Luke, I'm going to give it to you and put your closing thoughts in this as well. And then Graham and Wayne, I'm going to come to you for just a quick wrap up and closing words, because it's been a great conversation, but we're running out of time. Question in here from now. We see that there's a lot of cargoes which were probably destined for Europe now being deferred or refused because of the low gas price in Europe. Is it true that there's no shortage of gas in the USA, that in spite of the associated gas from USA gas wells been reduced in supply? You got that one, Luke?
So it's an interesting question. I think it pertains to the situation in the US gas market right now. Certainly, as I've said, there is no shortage of gas in the US. If we look at US gas storage levels, They're well at the high end of the 5-year range. And this is a combination of weak downstream demand because of the coronavirus, but also just cancellations of LNG supply. Well, that lost feed gas, that's got to go back into the domestic market. So what we've seen is we've seen the oversupply first in Asia, then shift to Europe as European storages filled. And now what we're seeing is that oversupply in the global gas market has shifted from European storages filling, and that gas is now staying in the US, which is the final balancing market for the global gas complex. So as I say, that's caused storages to be very elevated for this time of the year. Prices are very weak. We have at around a 20-year low on the month ahead contract, or was last week. But going forward, what this question also points out is that we are seeing a reduction in new wells and new rigs drilled in both associated gas and dry gas basins. And this points back to something I discussed earlier, which is that because of the oil price crash and because of record low gas prices, drilling has slowed down. And that's going to mean in 6-12 months' time, the US is going to see a reduction in gas production, in gas supply. Now, that is going to mean that we see a tighter US market in 2021, 2022, and we should see some uplift for Henry Hub in the coming year or so. Now, I guess just to finish with a couple of closing thoughts as well.
A few quick ones. Quick, I need them.
Yes, of course. Yeah, I think one of the key messages to take away today is gas doesn't really have a bright future. We see that through the projects which have reached FID in 2019. But if gas is going to be a major part of the energy transition, of the energy complex in Asia, which is probably the biggest potential market, what we do need to see is we need to see infrastructure build out, we need to see liberalization of the market, and probably most crucially, we need to be able to see gas compete on a price basis against coal, because that's where the big potential market is, if gas can push out coal in the Asian market.
Absolutely. No, thank you for that. Graham, give me a few closing words. You've got about 30 seconds.
Sure. Well, as a recap, there's a lot of doom and gloom around at the moment, not least in the LNG business, but, we remain pretty bullish on the long-term story. As has been said, it's really a story that will be driven by the return of Asian demand growth. It's not really a European story. Right. Yes, we're in a tough situation, an unprecedentedly tough situation for LNG suppliers at the moment. And that situation may extend for a year, maybe 2 years, but longer term, we see a need for new projects. And if that investment doesn't happen, we see potential for a tightening market situation by mid-decade or beyond.
Thank you so much. And Wayne, I'm leaving you the final word, a few words of inspiration for us before we sign off.
Firstly, I just want to say thanks for everyone, and thanks for inviting me, and thanks to our partners, Al-Attiyah, for putting this on and hosting this. It's been really good. I think for me, I'm just going to join with the guys here and just say, for us, it's all about what are we going to see over the next 6 months. How the world develops is key to what happens in our markets. I think not only do we need to think about recovery, we want to think about behaviour. How is people's behaviour going to change moving forward? Are we still going to do the same things we did in the same numbers? Things like this. But in terms of the gas market, I'm also with Graham. I'm still bullish on gas moving forward. We're going to need it. Projects are going to come. So I think the outlook is still pretty strong for the gas market. But again, what we need to be aware of is what's happening short term. But overall, I think, bullish.
Super. Well, thanks to the three of you. There's no reason for me to wrap up anything. I think you've done it absolutely succinctly and really with sort of great passion there. And again, I think great clarity in terms of what's going on in the market and really brought us up to date in what we need to be looking at. But I think one of the key takeaways, without a doubt, is just the state of the world at the moment, the state of the economy, the state of our sort of situation, whereby it is really uncertainty is the name of the game here, and it's looking ahead to next week, to next month. So I don't think we can get too excited. But then when we do look ahead, I think in the longer term, a lot of optimism there, because things can't stay like this forever. At least we're hoping not. So to Luke, to Wayne, and to Graham, thank you all so much for joining us. And indeed to all of you at home, thank you so much too. Thanks for your questions. This has been, great part of the series here. We've been delighted to be able to bring you this webinar. And we will have a final webinar in this series that is scheduled now for August. So keep in touch and we'll make sure we bring you up to date and let you know when that is going on. So once again, from the Al-Attiyah Foundation and Refinitiv. So thank you so much for joining us. It's been an absolute delight. I'm Ethno Trainer. We'll all keep in touch. And gentlemen, thank you so much for your input, your knowledge, and your expertise. Thanks, Carl.
Have a good day.
Thank you, everyone.
Thanks. Bye-bye.